Hi, I'm Mike Gassewitz, CEO of IAIC, and welcome to another episode of In Focus. Joining me today is Mike Williams. Mike is a portfolio manager who is also responsible for our industrial sector. Mike, welcome.
Thank you, Mike.
Yeah, that's going to get confusing. Anyway, that's classic. Yeah, Mike, before we dive in, maybe you could just explain what comprises the industrial sector.
Okay, the industrial sector at IAC is a little broader than many other firms might define it. We actually encompass manufacturing, heavy manufacturing, which is aerospace, heavy equipment, automotive. The second subsector we encompass there is transportation, which is typically railways, airlines, couriers. Thirdly, agriculture. And agriculture is both chemicals, fertilizers, as well as heavy equipment manufactured for the purposes of farming.
Okay.
And the fourth sector, which is probably our biggest deviation from the norm, is we encompass technology into the industrial sector. So those are the four major subsectors within our group and within our research division.
Okay. And so, given the volatility we're seeing in the markets recently, how has the sector been doing?
Well, again, because it's a broad sector, we encompass those four subsectors. It's not a one size fits all answer. Basically, there are subsectors within there that are struggling more so than the others, just due to interest rates and inflation. But generally, manufacturing has held up fairly well. Some of the valuations in the manufacturing sector have been pulled back a little bit just through general market concerns about what we call multiple contractions. That's a multiple of earnings, and also the economic outlook. And clearly, economists right now are calling for a recession if we're not already in one. That does impact manufacturing, capital orders, consumer confidence, purchasing managers, indexes, and their confidence in the economy. So that kind of thing does impact manufacturing volumes. Now, the good news is that the past earnings have held up actually quite well, considering where the market is right now. On the other side of it, though, if we look at, say, technology is far more sensitive to rising interest rates, and those valuations have pulled back more so than manufacturing. And we would expect, though, that we expect this because of the high multiples, we call it, but that is another sector where earnings are coming in fairly decently. Yes, they're pulling back a little bit. People are seeing some recessionary concerns there. Also, their input costs are going up. The cost of their labor, high-tech labor, obviously is going up probably far faster than other sectors are seeing their labor costs go up. But again, it depends upon the issue, how it impacts the various subsectors. Commodities impact the agriculture sector far more than some of the others. The price of oil, obviously, is impacting transportation. That's a big input cost for railroads and for airlines, for example. So there are many factors, many economic themes here that are having an impact on the industrial sector, but some more so in other subsectors than the others.
Yeah, it's a pretty broad segment, so to speak, of the market. So any thoughts on any particular of our core picks? Again, for the folks listening, it's how we basically create portfolios that yourself and other PMs, we have individual equities that we follow very closely. That is our core pick, ones that we feel comfortable recommending or putting into portfolios. And so, Mike, any ones that you want to highlight in terms of how they're performing?
Sure. Well, as first of all, we do diversify, and we even within the industrial sector, as I mentioned, we have these subsectors. So we try to diversify a portfolio within those. So you're not going to have 3 technology picks and only 1 transportation pick. So, but within the industrial sector, a few I could highlight. FedEx, which has been actually struggling. It actually had a big downturn a couple of weeks ago ahead of its earnings announcement. Those earnings disappointed, and more so FedEx's outlook for the economy going into 2023 was somewhat bearish. They were very concerned, and that sent some reverberation through the market with respect to transportation, couriers, and FedEx is typically what we call a bellwether stock. In other words, analysts will look to those earnings to see and look to their forecasts and their guidance to see what does this mean for the broader economy. So FedEx's performance ahead of what we're going into Q4 and into 2023 has the market somewhat concerned. But more so, the drop in earnings was quite substantial, and we saw that stock pull back substantially. On the positive side, our railroads have just reported, our Canadian railroads have just reported, and their earnings have beat expectations. Revenue is beating expectations. Turning to technology, Microsoft is doing well. Yes, they are having some cost issues. Their labor costs are going up, but they continue to perform well, even though they've seen a pullback of about 35%, again, mainly due to the interest rate environment that we're in. So what we feel with all of our industrial picks, they're all well capitalized. Mm-hmm. Most of them pay a decent dividend. In fact, many of them are what we call dividend aristocrats, continue to increase their dividends year after year, decade after decade. So, from that perspective, all stocks, all sectors are going to go through some ups and downs, and they're going to be challenged by headwinds. And it's no different for any of these sectors, any of the stocks that we hold. But we feel very confident that the stocks we hold within the industrial sector, within those subsectors, are all well capitalized, are all market leaders, are all able to pass on increased costs to their consumers over time, and we'll get through this okay with those picks. Again, we want to remain diversified. We want to make sure that we are invested in good, solid companies that have a track record of growing those earnings through good and bad times, and that's where we are.
That's a good reinforcement of our quality investment approach. So despite the bumps happening in the market and even on an economic level, we're investing in quality companies that can withstand that. So, I mean, that leads to my next question. I think you pretty much answered it in terms of, should clients be concerned at this point, or, do you feel they need to do anything? And I guess you basically answer that. No, we're basically in good shape.
Yeah, hopefully. I mean, many of our clients entrust us to navigate this for them, so they don't have to get up every morning and worry about whether the market's up or down 300 points. And, history shows us that if you remain invested in good quality names, in market leaders, in stocks that have, demonstrated consistent growth in their earnings, and there will be deviations from that from time to time, but over the long term, they are well invested, and they really shouldn't be making radical changes. When we see the market reacting the way it has in the past 6 to 12 months, this is not the time to start rebuilding the portfolio. I call it, we've set a journey. We started on one side of the ocean. Our objective is to get to the other side of the ocean. We built the ship to withstand the weather, regardless of what was thrown at us. So when we get in the middle of the storm and it is getting rocky, we might be getting seasick, but it's not the time to start rebuilding the ship. We built it when we set out to begin with. We're going to get to the other side. We just have to have confidence that the ship is strong enough, and it is strong enough. We have good quality names there. We shouldn't be doing anything. In fact, it is getting to the point where we might want to start increasing some exposure to some of those positions as the market maybe reacts a little too much to the negative side right now. So
Right.
that always creates opportunity for us.
Okay. Mike, thank you for this.
Thanks, Mike.
And, as always, folks, if you have any questions, don't hesitate to reach out to myself or to Mike, and again, as always, don't hesitate to reach out to your portfolio manager. Thanks very much.